Concerns about a new COVID variant rattling markets and triggering new
South
travel
Africa
bans
are
around
warning
the world.
against a new
Tonight, we'll
coronavirus
provide
variant
some context
extreme
and clarity.
concern.
We'll break down
Fear
what
could be more
scientists know
infectious than
about the
Delta.
variant
Scientists
and
are racing
explain
to
why
assess
health
the
experts say
the
the
new
variant is
coronavirus
not
variant
serious.
Omicron may result in
Oh shit. Here we go again.
Will the Omicron variant wreak havoc on the stock market? And should you be worried? Let's talk about it. How's it going, everyone? My name is Dan, but you can call me Malone. And last Thursday, the markets got quite a shake-up. In a year where the S&P 500 has advanced by over 25%, we were met with the worst trading day of the year. The Dow Jones fell by 900 points and the S&P 500 fell by 2%. And unless you've been living under a rock, you're no doubt aware that this was all because of the new COVID-19 variant known as Omicron. But it wasn't just US stocks which were falling. Market indices from Europe and Asia took hits as well, highlighting the global uncertainty caused by this new variant. In fact, the VIX, which is a measure of expected volatility in the stock market, increased by over 53% between Wednesday and Friday last week. This tells us that the market is expecting some pretty strong price changes in the short term because of everything that's going on. In fact, the VIX is oftentimes referred to as the fear index because, in a way, it does measure the fearful sentiment of the broader market. But it's not just Omicron that we need to worry about. Inflation is hitting levels not seen for decades, with US inflation hitting its highest level since 1990 at 6.2%. And the global supply chain crisis, which will no doubt be worsened by Omicron, is contributing to these levels of inflation. But what does any of this mean for you? Is it a case that the stock market is doomed and we're all heading into the next financial ice age? Or is all of this just a big overreaction? We're going to answer that in this video. But before we do, can I ask that you take just 1 second out of your day to leave a like on the video, and if you are new around here, don't forget to subscribe. The stock market's reaction to the Omicron variant was exactly how most of us expected it to be. We saw a big sea of red numbers and everyone automatically feared the worst. Global travel restrictions were introduced by many countries on the back of the news from South Africa, which many people weren't necessarily expecting. This resulted in companies like Airbus, Boeing, and many airlines taking big hits to their stock prices. And this kind of sell-off is to be expected because investors will no doubt have a clear memory of the rough patch that many companies operating in the aviation sector had to go through throughout 2020 and into 2021. But was the wider market sell-off justified? Looking back to March 2020, the S&P 500 fell by over 30%, and at the time this made sense. You see, back then we obviously knew a lot less about the virus than we do now. We were facing business closures, unemployment, and worldwide lockdowns of uncertain duration. And this was unlike anything that we had experienced in recent memory, and the stock market reacted accordingly. Since then, we've seen unparalleled support from central banks and federal reserves in propping up worldwide economies. We're also far more in the know with respect to the reality of living with COVID. But given the fact that the stock market has seen incredible levels of recovery since March 2020, and with the growing worry of a stock market bubble, I would say that yes, the wider market sell-off was justified, all things considered. Because at the end of the day, the valuation of any stock is the present value of the market's expectations for future cash flows. And if there's increasing levels of uncertainty around those future cash flows, i.e. due to the emergence of a new variant, then valuations are naturally going to fall. But what happened after the sell-off is something that we've all become accustomed to over the past 20 months. The stock market rebounded after investors took time to assess what the likely real impact of the Omicron variant would be on our businesses and wider economy, which for the most part is largely unknown. Yes, the new variant is cause for concern, but it's far too early at this stage to determine whether it will cause significant disruptions to our economies. And because of that fact, there is an optimistic case to be made. This is a case in point example of why it's so important to have a long-term mindset when it comes to investing. Nobody likes to see a red day in the stock market, except for long-term investors. If you're investing in stocks with the intention of holding them for decades, then red days like we've seen with Omicron just give you the opportunity to buy more at a discount. One bad day in the stock market is pretty much invisible on a 40-year stock chart. But if you're putting money into stocks or crypto with a get-rich-quick mentality, it's much more likely that you'll have less conviction and understanding in what you're doing, and therefore more likely that you'll lose money. My biggest concern about Omicron is the potential impact it will have on our global supply chains. You see, one of the most profound impacts of COVID-19 was the impact it had on our supply chain systems. We quickly realized that the mobility challenges presented by the virus were enough to halt our systems and cause bottlenecks. Those challenges haven't yet been overcome, with a shortage of truck drivers being one of the more pressing issues in many countries around the globe. And this is before we even consider Omicron and the additional mobility challenges that it may bring. So world leaders now need to consider how best to proceed with the new variant in terms of keeping our supply chains flowing and avoiding further bottlenecks. This is crucial in our battle against inflation. When you have a mismatch between demand for goods and services and the available supply, prices increase. When prices increase, the cost of living gets more expensive, and the real value of our money decreases. This is what's happening now in our global economy. We have lots of demand for goods and services as we emerge from lockdowns, but we don't have the supply to match demand because of the bottlenecks. And when you have a supply chain crisis, which stifles economic growth, there's also a risk of stagflation. Stagflation is essentially a bad cocktail made up of rising prices, unemployment, and slow economic growth. And it's the nightmare scenario that we're trying to avoid. But with the Omicron variant, economists are now warning against slower than anticipated economic growth, which may increase the risk of stagflation. Stagflation is much worse than regular inflation, because not only do you have increasing prices, but you also have decreasing wages and higher levels of outright unemployment. So clearly, this is something we'd want to avoid. There's much debate over whether the inflation we're currently seeing is transitory, i.e. temporary, but the emergence of the Omicron variant has certainly put a dent in that argument, especially if global supply chains continue to suffer. Economists are expecting interest rates to increase in the future to take the inflationary pressure off of the economy. Rising interest rates can reduce inflation because it becomes more expensive to borrow money, therefore reducing the amount of cash available in the economy to buy goods and services. But what the powers that be decide to do in the near future is ultimately unknown, and any thoughts or opinions on the matter is merely speculation. Same goes for the future of the stock market, and in the wise words of Mark Hanna, it doesn't matter if you're Warren Buffett or Jimmy Buffett, nobody knows if stocks are going up, down, sideways, or in circles. And if you're scouring YouTube looking for answers, I can promise you that you won't find any, or at least any good ones. There's a lot going on, and if you're new to investing, all of this uncertainty can make you, well, uncertain. Blocking out all of the noise made by mainstream media can be difficult, but it's necessary because all that matters is your destination. There's a great quote from American baseball player Yogi Berra, who said, "You've got to be very careful if you don't know where you're going, because you might not get there." We as investors want to be financially independent at some point in the future, but without clearly defined goals and strategies to achieve those goals, we can get lost along the way. It's not that what happens in the short term isn't important, but rather it's about having an investing strategy that makes the short term not important. So while Omicron and the risk of stagflation is cause for concern, it shouldn't really change your long-term outlook, provided you had one in the first place. But for those of you investing on the back of hype or on the basis of emotion and emotion alone, what you'll find is that small bumps in the road quickly turn into potholes. Do yourself a favor and start thinking about what long-term investing might look like for you. The other point I'd make is to always consider what the alternative to investing is. Yes, being in the financial markets can be scary at times because you have the ability to get real-time updates on the value of your portfolio. And yes, at times the value of your portfolio may decline. But think about it like this. If you were to keep all of your money in the safety of a bank account, you would be guaranteed to lose between 4 and 6% in today's inflationary climate. Remember, just because your money hasn't physically gone anywhere doesn't mean it's not losing value over time to inflation. People forget that the minimum goal of investing is to earn an investment return that at least outpaces the rate of inflation to protect the buying power of our cash. And we need to earn that return in a way that protects the initial value of our investment insofar as possible. What all of that means to me is that while you might question whether you should be invested in a particular stock, a particular crypto, or a particular fund, there's no question about whether you should have all of your cash sitting idle in a bank account outside of your emergency fund. All of that idle cash is wasted potential, and you're just guaranteeing yourself to lose money. So the question you need to answer isn't whether or not you should be investing or selling your investments. It's what investments can you make that will A, protect you against inflation, B, preserve the value of your initial investment, and C, allow you to sleep well at night. And from my perspective, making such investments with a long-term mindset is the absolute winning combo. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers.